I'm Amanda Horton, and I'm a relationship manager and vice president here at First National Wealth Management. I'm also a certified IRA services professional. And today we're going to talk about what you need to know about IRAs. So what is an IRA? An IRA is an individual retirement arrangement. Essentially, an IRA is a tax-advantaged savings account used to save for retirement. The two most common types of IRAs are the traditional IRA and the Roth IRA. The traditional IRA was created in 1974. It's been around basically as long as I have. And the Roth IRA was established in 1998. As referenced from its title, an IRA is an individual account, not a joint account. Sometimes clients ask the question if they can add their spouse as a signer or owner of their IRA. The IRS doesn't allow this since an IRA is classified as an individual account. However, a spouse can be added as a beneficiary so that they inherit the IRA funds upon your death. So you may be wondering, what is the difference between traditional and Roth IRA eligibility? Both the traditional and Roth IRA require earned income in order to make a contribution. Earned income is essentially what you receive from actively working, such as W-2 income, wages, salaries, or self-employment income. Now there are no age limits associated with contributing to either IRA type. Under the old law, if you were 70.5 or older, you couldn't contribute to a traditional IRA. The Secure Act of 2019 removed this age restriction. Keep in mind that contribution limits are based on the individual, so married couples each can contribute the maximum contribution limit to their IRA if they're eligible. Roth IRAs have modified adjusted gross income limits, or MAGI limits. So if you're a single filer, your MAGI must be less than $150,000 in order to fully contribute to a Roth. If you're a single filer and your MAGI is $165,000 or more, you can't contribute at all to a Roth IRA. Likewise, if you're married filing jointly, your MAGI must be less than $236,000 in order to fully contribute to a Roth IRA. If you are married joint filer and your MAGI is $246,000 or more, neither spouse can contribute to a Roth IRA. Some clients we've met with aren't aware of spousal IRA rules. There's a bit of an exception regarding earned income requirements. This rule allows for a working spouse to contribute to a non-working spouse's IRA. The catch is you must jointly file. Clients often ask us, should I open a Roth IRA or a traditional IRA? And it really depends on your tax situation. It's best to consult with your tax advisor regarding this. With a traditional IRA, you typically make pre-tax or tax-deductible contributions with tax-deferred growth. These are considered pre-tax contributions because typically you can deduct the IRA contribution amount from your ordinary income on your tax return. You are taxed on the IRA funds when you make a withdrawal from your IRA. An additional 10% penalty is applied before age 59.5. One question we often receive, does the penalty apply to the full value of the IRA or the withdrawal amount? And it only applies to the withdrawal amount. You're able to withdraw funds from your IRA penalty-free if you're 59.5 or older. Unlike the Roth IRA, a traditional IRA requires an RMD, or required minimum distribution, once the IRA owner reaches age 73. A required minimum distribution is calculated by taking the prior year's December 31st balance and dividing it by a life expectancy factor that the IRS provides. Traditional IRAs are popular with people who don't participate in a qualified plan or employer-sponsored plans, such as a 401k or 403b. With a Roth IRA, you make post-tax contributions or non-deductible contributions with no immediate tax benefit, but the beauty of the Roth IRA is that as long as it's been open for 5 years and you're 59.5 age or older, you don't pay taxes on the earnings you withdraw. Remember, you've already paid taxes on the contributions, so essentially this is tax-free retirement funds. Whereas with the traditional IRA, you pay taxes on both the contributions that have accumulated over the years and the earnings. An early distribution penalty of 10% applies only to the earnings portion of the withdrawal amount, not the full value of the Roth IRA, if you need funds from the IRA before age 59.5, as you've already paid taxes on the contributions. RMDs do not apply with Roth IRAs, so you're not forced to start withdrawing funds from the account at age 73. Clients often ask us, what is the deadline to make contributions? The tax filing deadline is April 15th this year. Prior year contributions are also a possibility. The IRS allows an individual to make a prior year contribution anytime between January 1st and the tax filing deadline of the following year. For example, I'm able to make a 2024 IRA contribution if I meet eligibility requirements anytime between January 1st of this year and April 15th. Those of you that have made a distribution this year might want to consider a qualified charitable distribution. This type of distribution allows you to take a tax-free withdrawal from your IRA with conditions. In order to take advantage of these tax-free withdrawals, you must be 70.5 years of age or older, and the IRA funds must be payable directly to the qualified charity, such as a 501c3. You can withdraw up to $108,000 for qualified charitable distributions for 2025. Basically, you get the best of both worlds. It allows you to reduce taxable income, and the withdrawal can be used to satisfy RMDs. And many people ask, is it better to make a 401k contribution or an IRA contribution? Let's go into the differences. The IRA is a plan outside of an employer-sponsored plan, which typically has more control and more investment options than a 401k. However, the 401k has a much larger maximum contribution limit than an IRA, which results in greater tax savings. Plus, your employer may match contributions to your 401k, so it's free additional money in your pocket. For 2025, the maximum contribution limit to a 401k is $23,500 plus $7,500 catch-up contribution for those 50 and older. Whereas the maximum contribution to a traditional or Roth IRA for 2004 and 2025 is only $7,000 if you're under 50. If you're 50 or older, you get allowed to contribute $1,000 more if you have earned income to support the additional contribution. This is what the IRS calls a catch-up contribution. Keep in mind that you may not be able to deduct your IRA contributions if you or your spouse participate in a qualified plan or employer-sponsored plan, such as a 401k or 403b. If you have any questions regarding IRAs, feel free to talk to one of us at First National Wealth Management.